let us say if I come out with a valuation of a company at about 100 and yours is 120, which is okay, but it cannot be 500, which means one of us is way off the mark.
Okay, so hi Siddharth, how are you?
Yeah, hi Vikas, I'm good. Thanks for having me. How are you?
Yeah, thank you all. Well, good to see you again. Yesterday was a good session and we really got very overwhelming support. There were about 10,000 investors who were watching us live, listening to us. So it was a great panel discussion. Thank you for accepting a request and joining this session. So what we'll do is there are a few investors who are there and joined here just now. So I'll introduce myself, I'll introduce you, and then hand it over to you.
Sure.
So you have a presentation to share?
Yes, I have. So.
Okay, lovely. Great. All right. So my name is Vikas Agrawal. I am the founder of AIF and PMS Experts India. Well, we are emerging as one of the largest platforms for investing in alternate investments and portfolio management services. So at AIF and PMS Experts India, one is to manage our clients' money. They give us the mandate to manage. The other is to educate and empower the investor community as a whole, and therefore we keep organizing these knowledge-based sessions, invite industry experts, fund managers, read their mind, trying to understand what's happening in the economy. And this whole conclave was conceptualized by ET Markets. So thanks to our media partners, they helped us to reach out to investors like you. Now, let me have the privilege of introducing Siddharth here. Siddharth Oberoi is the founder and Chief Investing Officer at Prudent Equity. He brings about almost 28 years of rich experience, full-time investing experience, more on the equity side. Over the last 12 years, advising and managing public capital, because he got the AIF license in the recent past, but he has been managing public money over the last 12 years. And under his guidance, Prudent Equity has been they've been kind of beating the benchmark on every 3-year basis. So that's the kind of track record they bring on the table. And yesterday I was mentioning that Siddharth has done extraordinary job of doubling the investors' money in a period of last 1 year by giving triple-digit returns. So that keeps him aside in terms of giving the complete stage that he's really done extraordinary job for his investor. And so without any further ado, I would request Siddharth to please take it over from here and share his valuable wisdom, experience, how he selects the stocks, what do they do differently at Prudent Equity. Over to you, Siddharth. Thank you.
Yeah, hi. So, Vikas, thanks. So we'll just go through a presentation where, here the topic is the current market overvalued, as everyone is sounding out. So we'll go through index measurements, and then we'll go through individual companies, and then try to find out if there are actually pockets of overvaluation, and where do we stand, as of today's valuation vis-a-vis the market and individual sectors and companies.
Before that, if I request you to please give us an idea to our audience about your organization and your 12 years of experience of managing public money.
Yeah, so I've been a full-time investor since 1996. Prudent Equity was started in 2012. We went through a research analyst license. Over the last 10 years, we've given out more than, I think, about 150, 200 stocks in the research reports with a success ratio of about 96%, which means every stock out of every 100 stocks, we made a profit in 96 of those. And then there were some certain restrictions with SEBI saying that you cannot give an allocation, etc. So we thought that the best way to handle this is to launch our own fund, which we did. So we started on day one with 100 crores of commitment, and now we are 300 crore plus AUM. Over the last 18 months, we're doing a CAGR growth of about 66% right now. Year on year, we are almost about 98% returns. So just recently, this month, we have launched our PMS as well. We are onboarding clients as we speak. So this is the organization background. And with that, we'll start the presentation. So Vikas, let me just briefly give you a summary of how we go about valuing a stock, what we think are the categories which are very important in the fundamental basis of how to approach stock investing. We come from a school of thought where we think that we need to estimate the business value of a company. So the concept of investing is basically you're buying something now which you think will be much valuable in the future. So with that, we can broadly say that we need to first understand what the business is, the economics of the business, how it generates its sales, what is the management, how it is allocated capital in the past, etc. So one way is that in a stable business you can estimate the business value of a particular company. Now my estimation will be different than yours, but it will be ballpark around. So suppose, let us say if I come out with a valuation of a company at about 100 and yours is 120, which is okay, but it cannot be 500, which means one of us is way off the mark. This is where where you can these are for stable businesses where these businesses have been around, or these industries have been around for many years. The second way is following what I call as a migration path. So sometimes what happens is that certain businesses are at a very nascent stage, or certain industries are at a very nascent stage, and you cannot actually pinpoint a value to those businesses. For example, we can say Zomato. Zomato as a category didn't exist 10 years back. Delivery of food, via a gig channel. So this was not a category a few years back. So how do you value such a company where the value is to emerge in the future? So the best way is to follow a migration path where you estimate that this is a company and how many people would, how many restaurants would join, what is the scalability model of this company, and then you estimate what this company will be 3 years, 5 years, or 10 years down the line. And through that, you can say that, I'm buying this company at a certain market cap, and 3 years, 5 years down the line, while I cannot pinpoint what the value of the business right now is, I know that this is a very cheap valuation market cap wise, and this will become a very large company, a very large category of business in the future. So these are two broad parameters of valuing a stock or a company. Then there are others like special situations, mergers, demergers, and those are outside this valuation categories because they're very specific to the event. Nowadays, what is happening is that there's a lot of momentum play also in the market. So, there's a theory going around that, if a company is growing at, let's say, 60-70%, you don't decide the value, let the market decide that value, what market perceives that value to be. That is, for us, is a folly. It is not the right way of judging a company, because then the output is not in your hand. You are groping in the dark in that sense. So, we need some kind of a comfort, some kind of a valuation comfort, or some kind of a growth comfort where we know that this growth will continue and the X company will become much valuable in the future. So these are the two parameters that we follow in evaluating and judging a stock. Now, coming to where we are presently in the market, and we'll just go through a few slides where we'll show that how, if the market is overvalued or not, and then we'll go company specific as well. So, what I have done here is that we have eliminated the COVID years, that is 1920 and 2021, just to give a proper view, because these were aberration years. So we've taken the pre-COVID years and the post-COVID years to judge where we are in the valuation cycle. So as you can see, the P ratio of the Nifty 50, let's take up first, was 26. But the commensurate growth was 5% during pre-COVID times. Post-COVID times, it was 24 times, and the growth rate was 37%. Now, this 37% is also a consequence of low base effect of the COVID years. But broadly, we can say that, this Nifty has been stable at 26, 24. Right now it's 22 times. The returns have been 14% and 15% respectively. Now, if you just do a ballpark judgment based on prima facie numbers, you will find that the market, the Nifty, is not as overvalued as the perceived notion in the market right now is. In fact, it is at the lower end of the P ratio, and especially looking at the fact that we are growing at 37% we grew 37% on the EPS. Right now it's about 15-18%, but that's also even better than the historical averages. Now, if you go a little lower down the hierarchy, you'll find that there is the Nifty 150. Pre-COVID also, this was very expensive at 40 times. It's 40 times right now. But what has happened is, just look at the growth aspects. The growth during that time was 16% CAGR over this 2-3 years. The growth post-COVID has been spectacular with 73%. The returns, therefore, have also been commensurate, 9% pre-COVID, and post-COVID it is 29%. Now, again, if you look at the historical patterns of post-COVID and pre-COVID, you can say that it is at a little higher end of the band, but there is no massive bubble as perceived in the market if you look at the indexes. In fact, if you go lower to the small cap 250, you'll find that the P ratio is 72. This is pre-COVID. So this was a time when the small and mid cap were very, very heavily overvalued. The EPS growth that time was 20%. Post-COVID, the earnings had actually grown at 52%, but the valuation plateaued. Right now, it's just 28 times. The returns, see, the starting P was so high, 72 times. Therefore, the returns were very meager, 1%. Post-COVID, it was 26 times, and the returns have been much better. So, what we can conclude from here is that whenever the starting P or the starting valuation is high and the growth is not commensurate, you will have a lower return. And that goes on for the index and goes on for the specific companies also that we'll go through in the next slides. But broadly from here, we can conclude that while there may be pockets of overvaluation, and that happens at all types of markets, each cycle brings with it some overvaluation and undervaluation. But broadly, we cannot conclude that this is in a bubble territory, and as the general perception is right now. So let's go to the individual ingredients of these components. This is of the Nifty 50. Again, here we will conclude that if you look at the starting P, it was 27. There was commensurate growth. So if you just go line by line item, you'll find that while there were some companies where the P was elevated, but the growth compensated for it, and therefore we had these returns. So now these are 5 years CAGR returns. On the other side, let us look at the worst performers of the Nifty constituent. Here for financials, we've taken the price to book value. But if you see, look at the Kotak Mahindra Bank, IndusInd, the PE was so elevated. Look at HDFC Life Insurance. The price to book was so elevated, and the commensurate growth did not pan out as anticipated by the market. And therefore, while the current valuations have flattened, the returns have been very, very meager over the last 5 years. Even if you look at a company like HUL, a very high elevated P, the growth did not pan out. It was very meager for the last 5 years. And we had very, very low abysmal returns in the past period. So here again, we'll see that whenever the starting P is low or the starting valuations are very comfortable and the growth rate are very high, but that results in superlative returns going forward. So if you look at just the top 3 stocks here in the Nifty 150, which is given the maximum returns, you see low single digits P ratios. The next 5 years growth have been phenomenal. It's in double digit CAGR growth. Right now, the P's have been very, very high right now. So we can, it's anyone's guess what they will do in the next 5 years. But looking at the anecdotal data of the past, we know that these stocks may not repeat their past performance unless the growth rate is commensurate of what they have done in the last 5 years. So again, we see the worst performers where the P was elevated or the valuations were high, and the growth rates did not come out as was the market was expecting. The returns have been very, very low. In fact, some of these are very good brands, Nerolac, Bata, some of these are very brands, and because pre-COVID there was a lot of a fancy for branded companies, they were bid very high in terms of valuation. The growth didn't pan out and the returns were very bad. So time and again, we'll see the same phenomena panning out everywhere, that if within the Nifty constituents also, although Nifty did 25% CAGR over the last 5 years, within the component, there have been companies which have delivered superlative returns. And same here, on the right hand side, you'll find that while the returns were great, there were companies which gave negative returns because both the parameters should fall in place, where the starting valuation is low and the growth also should be commensurate to what the valuation the companies are getting. Now we'll go to the lower. So if you look at the CAGR growth of the small cap 250, they have almost given 25%, 25 for the 150. But if you go to the individual components, you will find that the companies which are given 100%, this is CAGR returns. This is not a 1 year or 3 year return. This is not cumulative return. This is a CAGR return. Again, the valuations were very, very low. You look at individual example, Jupiter Wagons or Alcon Engineering, very, very low single digits PE. The growth has been phenomenal over the last 5 years, and therefore that resulted in extremely high CAGR returns. We'll take you through individual stock as well as case studies in the next slide, but let me just take you to the laggards first. If you look at here, here you'll find that for financials we've taken again price to book, but in some of the cases here you'll find that the starting PE or the valuations were not very high. Like I've said before, both the parameters, a low valuation and a reasonable good growth, both parameters should match for you to deliver the returns. Here again, you can see the number 4 and number 5 category. The starting P was reasonable, but the growth didn't pan out, and therefore you had negative returns for over the last 5 years. In some of the companies, again, brand companies which are very, very fancily valued, the P ratio was so high that even there was a mega growth, even there was a double-digit growth, still the returns were zero because of the starting valuation. So, our concept of investment is exactly the same, that your starting investment should be at a very cheap valuation. But the second criteria is that we should at least have a double-digit growth going forward, and this growth is visible, quantifiable to some extent. This is broadly that this sums up our investment thesis, and in the index also it proves that if someone follows these up, if both a cheap price and a good growth matches, the results are phenomenal. So let's now take you to individual companies. So again, this is a large cap, Kotak Mahindra Bank. As you can see, the starting book value was at 5.6 times. Now, even the P ratio is very high. Over the next 5 years, the stock gave a return of just 3%. It didn't even, forget beating the index. It didn't even cover the cost of inflation. So now what happened was that over the last 5 years, the PB, the price to book, has now flattened to 3. The current PE is also very low at 19 times. Now, if the company is able to grow its earnings as it grew over the last 5 years at 20%, we may see some returns from here on. But this is just to showcase you that if you're, no matter how much fancy the stock, how much great company it is, you know, corporate governance wise, Kotak Mahindra is as good as they make. So even if the starting valuation is high, even if there is growth, Kotak Mahindra grew at 20% CAGR, yet the returns were not good because the initial valuation was very high. So time and again, you'll see that these both parameters should meet a low valuation to start with and a subsequently high growth. Now these stocks are very difficult to get in the market where, you know, both the parameters meet, but you know, that is where the growth, that is where the good CAGR returns lie. So now let's take to the case study 2. So this was a small cap at that time. Here, you know, the starting P was 21, which cannot be considered low, but over the next 5 years, the CAGR growth was phenomenal. 45% growth in revenues and profits it generated, and therefore the stock returns was 72% CAGR. Now, what has happened in between this is that there was an infra boom as well, and so that helped, and therefore you know, the stock also got fancy. But nevertheless, the profit growth was 45% CAGR, so that helped propel the stock to where it is right now. And the returns have been 72% CAGR. Right now, again, the stock is valued very, very excessively at 55 times. So anyone who thinks that the repeat of past 5 years would happen would need to understand that from here, the growth needs to be 60-70% CAGR over the next 5 years to generate these kinds of returns. Otherwise, then we'll have a very abysmal low returns going forward. So we'll do a case study of you know, whether this kind of a valuation parameter where your low growth and low valuation and high growth stands. But you know, this is a third case study where we're going to show that there are pockets of overvaluation. In fact, it is so grossly overvalued. Let me just take you to the slide here. So you know, these are two multinational companies, Siemens India and ABB India. Now let's go to Siemens India. Siemens has a global market cap of 133 billion. It does 84 billion of sales and about $8 billion of profit. Now Siemens India, its subsidiary, it does only 3% of its revenue, of the global revenue, and less than 2% of its profits. Yet the subsidiary is valued at 25% of the global market cap. So the overvaluation is so visible that a subsidiary that does just 3% of the revenue is valued at 25% of the total global market cap. Now, one can say that, you know, because India is growing and Siemens India may grow at, you know, but nevertheless, even if you do a 60 to 80% CAGR growth, it still doesn't justify the valuation that Siemens India is getting. Similarly, with ABB, the global conglomerate does a revenue of 32 billion. India does just less than 4%. It's valued at 23% of the global market cap. So these are glaring examples of how there is a bubble in certain pockets, and no matter how much growth you pinpoint to in the future, you will not be able to justify this. In fact, I can stick my neck out and say that, you know, some of these companies are you know, valued 5 years from now. So you know, that is the kind of valuations these companies are trading at. So then there's another thought of investment valuation that we do is that, you know, valuation for us emerges from time to time. So this is one company which was till recently our top holdings. In the fund, we bought the stock at 80. So this was, we put the maximum we could in on a particular stock. The stock gave returns of till here at 210. So now what happened was here, this is a way of telling that while you buy a stock cheap, but if the growth continues and accelerates at a certain rate, then value emerges at even a higher price point. So for us, when we had bought the stock at 80 rupees, value emerged at even at 210, where we added to our position. So these are some of the cases where while the stock goes higher, the growth rate of the company accelerates even at a higher rate than anticipated, and therefore one can do an additional investment at those prices as well. Right. So to conclude, can we stack the current valuations against historical ones? Well, sometimes we can, but there are pockets of overvaluation. And historically, it has been seen that the market has, whatever it traded at the past is now trading at those same valuations. So we can conclude that it's not a very, very bullish market as thought of. Of course, there are pockets of overvaluation. And in this kind of market, there's very special situations that keep coming: demergers, mergers, large dividend payouts, takeovers, which keeps on, bringing in new opportunities and new stock ideas. Yeah. So with that, Vikas, we can conclude the presentation.
You can bring me back. Yeah. Okay, thank you so much. Thanks, Siddharth, for giving us a different perspective altogether. And when you compare that with earnings and the benchmark, obviously you get a different picture altogether. So thanks for sharing your valuable wisdom with us. And on behalf of entire AIF and PMS Experts team, we also take this opportunity to congratulate you for the wonderful job that you're doing. Can you also talk to us about how has been the performance? While you talked about the percentage, which is 96%, but your performance, if you got a chance to calculate in a CAGR term for the last 10 years.
Yeah. So in the research analyst, what we can do is what we did was we took out the price at which the stock was recommended and at which was sold. So that came out to be something north of 40% CAGR. Some of that, for the last 6 years, we have audited that as well. But because it was not at the portfolio level, that couldn't be the right judgment for that. But in the fund, now when we started the fund in December 2022, the market itself was very overvalued at that time. So we are very, very price sensitive, and we waited for almost 3.5 months before we started to deploy capital. In fact, we were almost 92% cash for the first 2.5 months of 2023. Then we got the opportunity in March, and between March and June, we were actually fully invested in those 3 months. And the churn of the portfolio is quite high. So we made the portfolio in such a way that there are core holdings, and then there are special situations that we keep churning from time to time. But some of our core holdings have been with us for more than 1 year, 15 months till now. So this is how we do. And we also did our own stress test, where we found out that how liquid the portfolio is, and we figured out that we can actually sell the entire portfolio in 2 days. So that's how liquid it was. Also, in terms of drawdowns, we had the maximum drawdown was 4% or 3.5% in 1 month over the last 18 months. So we've been able to deliver these returns with reasonable risk covered.
But this 1 year of drawdown, I think, would be a too less time period. But if I have to go back again and then see what kind of drawdown that you have seen, because we saw 2018, 19, and then 20, where 100 rupees of benchmark becoming 37 rupees.
Yeah. So we follow the calendar year, and 2018 was the year where the performance was low. I think it was again -3% or 4%. In 19 it picked up. In 20 again, because we follow the calendar, and the December came, the COVID period had probably come to a little more stable. So luckily we were able to scale through in that year as well. But personally, I've had probably 1996, 2008, 2011, 2018. Those were the 5 down years of my career.
Yeah. And what is the kind of skin that you have in the game in terms of your own money invested in the fund?
In the fund? So in the fund, whatever the mandate was, we've put in. So in day one, we started with 5% of the AUM is now in the now about 8% of the AUM is our own money.
I got that. So with that, we'd like to conclude the session here. Thank you so much, Siddharth, for
Thank you, Vikas. Thank you so much.
really appreciate.